We are witnessing the largest extraction of capital in the history of the technology industry. A small group of artificial intelligence and aerospace firms are preparing to pull nearly $200 billion out of the public markets, a figure that exceeds the proceeds of every major U.S. IPO from 2022 through early 2026 combined. The staging ground for this rotation of wealth is the Nasdaq exchange. SpaceX is targeting a listing here with an incredibly thin public float, only about 3 to 4% of its total equity. Because the order book is so narrow and 30% is reserved for retail investors, even small shifts in demand will trigger massive 20 to 30% swings in the stock price. OpenAI CEO Sam Altman is moving just as aggressively. Just days after a federal jury rejected Elon Musk's attempt to seize OpenAI's assets, Altman filed a confidential prospectus with the SEC, clearing the runway for a public debut as early as September. This disclosure reveals the math beneath Elon Musk's consolidated empire. By publishing its audited S1 financials, SpaceX confirmed that the combined social media network X and the startup xAI are operating at a steep deficit, recording a massive $6.4 billion operating loss in 2025 alone. This competition has evolved into an intense battle for the public market liquidity required to build the next generation of global infrastructure. This chart shows the aggressive growth OpenAI promises investors. To justify its trillion-dollar valuation, it expects to scale to $184 billion in revenue by 2029. But this revenue goal sits on a $1.4 trillion infrastructure spending commitment to keep model scaling. This infrastructure relies almost entirely on high-end hardware, specifically massive Nvidia GPU clusters, like the Colossus supercomputer, which now runs over 220,000 chips. If frontier AI companies are draining $200 billion from the public markets to fund over $1 trillion in hardware, we have to look at where that capital is actually being sourced. It's being pulled directly from the traditional tech economy. The pressure to fund these AI requirements is hitting the campuses of established software giants, forcing them to gut their own operations to pay for access to the new technology. Financial software giant Intuit recently announced it is laying off 17% of its global workforce. They are spending up to $340 million in immediate severance to eliminate 3,000 roles, primarily targeting middle management and regional software hubs. These companies are liquidating their human workforce to subsidize their licensing costs. Intuit is redirecting the capital saved from payroll directly into multi-year API deals with OpenAI and Anthropic. While Intuit claims these cuts increase efficiency, the company has spent over $103 million lobbying to keep the U.S. tax code complicated. They have spent decades preventing the IRS from offering a free filing system to protect the revenue generated by their own software. These layoffs execute a direct transfer of wealth, pulling capital from the middle-class workforce to fund the high-burn infrastructure of AI giants. This concentration of wealth is creating a deep economic distortion across tech hubs like San Francisco. Investor Didi Das notes that a tiny group of roughly 10,000 early employees at firms like OpenAI and Nvidia have achieved liquid wealth exceeding $20 million in just 5 years. This demographic chart shows the resulting divide. On one side, the new AI elite. On the other, a massive block of software engineers earning $500,000 a year who now face a shrinking job market and role elimination as companies flatten their management layers. With 43% of CEOs now planning to cut junior roles in favor of automation, the traditional corporate ladder is effectively closing. In this environment, technical expertise is being overshadowed by a high-stakes lottery where professional security is determined by being at the right startup at the exact right moment. While Wall Street focuses on these trillion-dollar valuations, the underlying systems are starting to show signs of critical fragility. Security researchers recently identified a massive flaw in the Langflow AI framework. State-sponsored actors exploited a basic policy error to gain remote code execution, compromising entire enterprise workspaces and exposing sensitive API keys. Simultaneously, the automated Megalodon campaign attacked the software supply chain, injecting malicious code into over 5,500 repositories in a 6-hour window. These attacks exfiltrated critical cloud credentials and private SSH keys directly back to external command and control servers. This fragility extends to the physical world. Waymo was forced to suspend its autonomous robotaxi service across the entire Atlanta metro region after its vehicles repeatedly drove into flooded streets during a heavy storm. These failures highlight the danger of the current tech economy. Trillions of dollars in value are built on technologies that are scaling far faster than their security and physical safety architectures can support. Executing mass layoffs to pay for third-party AI access is an unsustainable long-term strategy for any enterprise. The organizations that survive this transition will be those that redesign their workflows around secure hybrid teams, where human experts and autonomous AI agents operate as a single governed unit. The current capital race is a high-stakes gamble on the future of global infrastructure. Victory will belong to the organizations that can orchestrate these new systems, rather than those that simply use them to automate legacy processes.